Zensar Tech is on our radar today. For Q2, the company's performance was relatively subdued. Its revenues and margins came in largely flat despite the strong run in the stock in the last 1 year. Rima caught up with Manish Tandon, who's the MD and CEO of the company, to discuss their Q2 performance and began by asking about the top-line growth and the demand environment. Listen in.
Had a pretty good quarter in Q2 based on what we are seeing in terms of the industry headwinds. We actually grew 0.6% quarter on quarter. And more than the revenue growth, I am focused more on profitable growth. And I'm pleased to report that our profit after tax for the first half year already has exceeded whatever we had done in the whole of last year. So that is something that we are all very proud of, that we are delivering not just growth, but profitable growth to our investors. As far as H2 is concerned, as you know, H2 is always a tough quarter for the industry because of furloughs, less number of working days, so on. I don't expect it to change materially this year. It's not that there are a lot of tailwinds which will help us get there. So I'm looking at more of the same as far as this H2 is concerned.
So H2 revenue growth will be similar to this, what we've seen in Q2, about a 0.5% kind of top line growth? Or do you think, given the headwinds you spoke about, the seasonality, we could even see a negative growth?
Well, we had a good order book. We had very good order book, 195 million, as against previous highest was, I think, previous quarter was 151 million. But again, there is a trade-off between order book and revenue leakage in terms of projects getting cancelled and so on. So we have to balance that out, and we will see how that balancing act plays out in the quarter.
Is there a risk of negative growth in Q3 or Q4?
We don't comment on exact numbers for H2 or for future. We like to write the exam like a good student and wait for the results.
Fair enough. You've also reversed FY23 management bonuses, which are benefiting your margins this time. Could you tell us what led to that? Why did you decide to reverse the bonuses which were given?
No, these were not. First of all, these bonuses were not given. These were provided for, number one. And we are trying to make ourselves more and more a performance-led organization. And as you know, the performance for the entire FY23 was not very good. And this was reflected in our share price. This was also reflected in how the investors reacted to us. And we felt that, given the unhappiness of the investors with our FY23 results, it'll be unfair for us to give supersized bonuses to everyone. So these were not, again, I would reiterate, these were not given out, these were provided for.
The point about deal wins at $195 million, it's up 38% quarter on quarter, up 26% year on year. But I believe some of the deals which were expected to close in Q1 got closed in Q2. Some of the deals got preponed from Q3 to Q2. So this run rate of $195 million is not sustainable. You could go back to that $150 million quarterly run rate on deal wins. What's the pipeline?
I hope not. I hope that we will do much better than what we did this quarter. The pipeline is good. And if you see holistically, I think, except for one vertical, which is high tech, we have done really well across the board in terms of our service lines and in terms of our offerings and in terms of geos and other verticals. So the pipeline is fairly good. As I said, one has to do that balancing act between revenue leakage and pipeline, and we'll see how it pans out.
What was the extent of revenue leakage in Q2?
We don't, we don't measure revenue leakage in terms of okay. Let me clarify. Revenue leakage means that declining accounts, right? And I would say the overall revenue leakage was about 5 million in just Q2.
Okay. These top 5 clients, they continue to fall. And now the revenue contribution from your top 5 clients is 31.5%, the lowest in the last 5 years, I'm sorry. Can you tell us what's happening with these top 5 clients? Which one is under pressure? Is it all to do with high tech? Tell us a little bit more on how to read this.
I think this is a positive sign. As you know, we have had a lot of concentration risk in Zensar in terms of revenues, and the board has been trying to diversify and dilute this concentration to the extent possible. So we will continue to. I mean, there are two ways of diluting your concentration risk. One is to reduce the concentration, reduce the large accounts, and the second is to grow the other accounts faster. We are obviously taking the second approach. In fact, our non-top 20 accounts have grown faster than the top 20 accounts. And this is all driven by our desire to reduce our concentration risk to some extent.
One word answer, Manish. Is the demand environment better, same, or worse compared to 6 months ago, according to you, in terms of discretionary spending and decision making?
It's pretty much the same. And I strongly believe that as long as the Federal Reserve is increasing interest rates, inflation is going up, and as long as quantitative tightening is going on, this environment will remain pretty much the same.
Okay, so that's the management of Zensar Technologies. They are focusing on more profitable growth going forward. We need to take a short break, but we'll put the focus on Bajaj.